All right. So, hey, welcome everybody. Thanks for hopping on here on a Tuesday evening. Appreciate you all taking time out of your day to join us. I'm Noah Scheinbaum. For those of you who I have not met, founder of Front Door Defense. Our mission is to attract and prepare the best talent to make an impact in the defense market. And I'm excited to be here today with John Barry. John is an expert. He is not kind of your typical backroom accountant. He's somebody who has engineering expertise on the front, or their entire organization has deep engineering expertise with how to deal with some of the tax advantages available to small businesses and to startups in this country, specifically working both specifically and generally on the national security world and beyond. So, part of what we're doing at Front Door is trying to make available a series of insights on niche topics that are typically the provenance of those who can afford expensive monthly retainers to high-end consultants. And what we want to do is to share enough about those niche topics for those of you who may be starting companies or growing companies or running companies already, to just understand maybe what it is that you might not know, and then give you the opportunity to follow up, to ask some questions, and to seek out resources that will help you best position your organizations to be successful in what is a fiercely competitive environment. And so John today is going to talk about one particular tool available to startups and beyond, which is the R&D tax credit. There are many, many layers to that conversation. We're going to keep this fairly high level. And the goal is to orient you all to what's a really important tool. John will go through his presentation. We will save time at the end, probably about 20 to 30 minutes for open Q&A and discussion. And then we'll invite you, afterwards to follow up and connect with John and with Knarr if you're interested. If you're interested in going in depth, we're working on developing a course on some of these topics right now through Front Door, and so we'll keep you posted on that. But really, this is meant to be a resource for the community. So we want your feedback, regardless, good, bad, or otherwise. And just really grateful to John for taking some time out of the busy day to share his wisdom with us. So with that, John, I'm going to hand it over to you.
Absolutely. Can you guys hear me all right? And can you see the presentation? I think those are probably the two things.
No go on slides, but we can hear you.
Sounds good. Let me back out of here real quick. And if that's the case, no, I may just have you pull it up if that's okay. Well, I just get started and I won't even worry about that piece of the puzzle. But yeah, thank you for the introduction. I'm really glad to be here. I think more importantly for me, what I'm trying to share with this, we have worked with defense contractors for probably 20 years. We've been around for a little bit more than 20 years, and so this is really a passion project for us, and something that is really exciting for me to be able to share. As we've tried to help defense contractors, their accounting firms, their advisors navigate this opportunity for, like I said, for more than 20 years. So as Noah said, I think what's really, really important is to go through a framework here of what this is, what we've really designed this to be, and what it isn't. So I think from a high level overview, we want to be able to provide you guys the basics of the credit. And give me one second here there we go. Yeah, just the basics of the credit. What are the includable expenses? What are the things that you guys can identify to help you determine, is this qualified activity or is it not? And then there's also some layers here of defense contracts in terms of misinformation that we often see when we talk to defense contractors. We'll find a lot of them will say certain things that are by the definition of the code technically true, but when you dig deeper into the regulations, you'll find out that The way that it is worded is not really how it's applied. So we'll walk through that from a defense contractor perspective. But again, as you'll see on this last piece, help you guys identify what the impact of the credit could look like. I think what's really, really important is to say, okay, there will be a lot of general answers that we may have to some questions. But the true answer in terms of your specific situation or a specific situation will always likely be determined with further conversation. And we can obviously have that if that's something that you guys feel pertinent. But this is not meant to be financial advice for your specific situation today. But again, I think we can provide that framework to help you understand, okay, I think this is something that might be qualified, or this is something that may not be qualified.
Awesome. I'll just invite everybody, if you have questions as we're going through, just go ahead and drop them in the chat, and then we'll go to open Q&A in the back half of the time here. So John, I just tried to give you slide control. See, are you able to use that?
There we go. Perfect. I will do that. Thank you. So just some background on who we are at Hull & Knarr. We are R&D Credit specialists. We are based here in Indianapolis, Indiana. We do other state and local incentives, but in reality, the R&D Credit has been our bread and butter for, like I said, for a little bit more than 2 decades. We come at this from a much different perspective than others. We have found over time, just a little background on our company and how we started. Our founder actually worked for an accounting firm, and he was tasked with new business development. And he came across this in the early 2000s and found that the IRS was using degreed engineers in order to audit the credit. So he actually went to the partners of the firm and he said, hey, what do you think about this and hiring degreed engineers? And they said, well, we're an accounting firm, we're not engineers. And so he actually just took that and spun Hull & Knarr from that conversation. And we have degreed engineers on staff. We also have CPAs, but we end up taking a look at the credit from that engineering perspective, because what it allows us to do is really build that contemporaneous documentation. And obviously on the report side of things of what we do, build the quantitative and qualitative analysis from that engineering perspective, where we can actually talk to those engineers and be able to speak the same language and determine, okay, yep, this is qualified, this is not. For us, we work with a wide variety of groups. We work with companies directly, we work with accounting firms, we work with VCs, other strategic advisors. I think the most important thing, we get asked this all the time, are you guys an accounting firm? We are not. You would not want us to file your taxes. We definitely do not do that. But what we do is we build the package of the R&D credit so that it is very, very seamless for an accounting firm to plug it into their software and be able to get the benefit for their clients. So I mentioned this before. I felt it was really important just to share. In a perfect world, the way that this works is we serve as an extension of the accounting firm. Yeah, we might have direct relationship with a government contractor and who may be responsible for overseeing the R&D credit within that organization. But in reality, we need to have just as much conversation with accounting firms or external CPAs as well, just to make sure that everything is plugged into the actual software, everything is filed correctly, they understand how it can be applied, so on and so forth. And we really view it, like I said, as a circle here, where it's not just a one-way street where we're working, one-on-one with the client. There is interaction with the CPA firm, and that's how we found just for this partnership to work best. I think you're finding more and more that people will be kind of all in one roof and all that. We still, again, find that working with the accounting firm specifically, or whoever is filing those taxes, it just seems to be the perfect marriage, if you will, for making sure that this is something that is done properly. All right, I'm going to move into the basics of the credit now that I got through that background. I think first and foremost, what is the R&D credit? It is a financial reward for companies that are creating or improving products, processes, and or software with those activities happening in the United States. Well, in some cases they'll be happening offshore, and those will not qualify if it is happening offshore. So we're looking at really activities that are happening here in the United States. The benefit comes back to companies in one of two ways. It will either help them offset income tax or payroll tax. And I'll go a little bit further into that here in just a second, but it has been, the credit itself has been around for 40 years, more than 40 years, but traditionally it was used to only offset income tax. So it wasn't until the end of 2015 and really implemented in the beginning of 2016, where it became more inclusive, where startups were able to use the credit, because traditionally, again, they might be running, again, just starting their businesses and running at a loss and not, how am I going to be able to use this against income tax? It became a lot more inclusive for them to be able to offset payroll tax as an option. Again, we can go into specifics on how that actually happens. But again, a lot more inclusive at that point in time for businesses that, again, are not profitable. So what does it really mean for a company? Simply put, the R&D credit has the ability to reduce tax liability, increase cash flow. So again, what you were going to pay in taxes, you are able to reduce that and use those dollars elsewhere. And the way that we like to at least show this is there might be some misperception about government contracts and how that does apply. And again, that's the whole purpose of this. We find government contracts or just commercial contracts that fit a certain criteria really do cover, or they make up a massive chunk of what a company's credit can look like. We'll just kind of show a few of the activities, but you have cost overruns that can be included, bid and proposal time that can be included. IR&D can obviously be a big chunk, and IR&D is generally what we refer to as low-hanging fruit. Most providers are able to look at IR&D and be like, yep, that qualifies, because that's pretty self-explanatory. The government contracts is where we see a lot of missed opportunity for those that are performing SBIR, STTR work and other contracts as well that fit the criteria that we'll talk about soon. Okay, so some common indicators of qualified research. I think first and foremost, if you're looking at, okay, what would constitute, or what can I look for that would give me some ideas that I have qualified research? Degreed engineers or scientists on staff, those technical personnel, that's always a really good indicator that there may be some R&D on staff. Patentable products or production methods. I say patents, again, they are a very good indicator. They actually meet what's a safe harbor, and that means that it meets 2 of the 4 criteria of the 4-part test. The 4-part test is something I'll walk through here in just a minute. But again, this is the patent itself is able to provide contemporaneous documentation, because hey, this was R&D that was being executed at a certain point in time. And so it is just, again, it's a great source or a great indicator of, yep, there was R&D that was being performed at this point in time. So we have manufactured products with a highly automated process, developing software, and again, government R&D projects from the SBIR, STTR world. All right, I'm going to move quickly into qualified expenses. So we're talking here in general. I'm just going to kind of zoom through these here real quick, just they're all on the same page. But when you sit here and you're looking at what are the qualified expenses, there's 3 big buckets, if you will. You have wages, materials, and outside contractor costs. So when you're looking at, in general, the wages are oftentimes going to be the biggest component of the qualified expenses. You're looking at principal investigators, you're looking at direct supervision, direct support. Oftentimes what we will find is that people will end up putting, hey, these are the people that worked in the R&D, and they will include their time, but they won't include ownership that could be involved, or those that are making a significantly higher wage, they'll leave those dollars out. Again, we're taking a look at the full scope of who is involved in the R&D process, from those that are actually executing the work to those that are overseeing it as well. Materials, again, this is pretty self-explanatory for those that are creating prototypes, materials used in a process, pilot runs. I think we see pilot runs sometimes as well as you start looking into phase 3 contracts. Also, some types of software can be used and included in that as well. And then lastly, subs and consultants, those that you are working with, those are able to be included at 65% of the incurred cost. So that could be for testing services, again, outsourced R&D. We have software development in here as well, just to kind of give you a flavor of what some of those examples could look like. Okay, so I think first, as we talked about, okay, these are the wages and the way that you can quantify your expenses. The most important thing of the R&D credit is this 4-part test in determining what is and isn't R&D. I think a lot of people have this notion in their head that R&D is simply lab coats and that vision, if you will. And in reality, the R&D credit or the regulations reward R&D at a much lower level of innovation. And what has to happen is that the activities have to pass this 4-part test. The most important pieces of this, as we tend to find, are the second and third. But number one, the activity has to be technological in nature. So as we always say, it's got to be rooted in the hard sciences. You're looking at physics, chemistry, biology, computer science. We're not looking at things like market research. We're looking at something that, again, technological in nature. That is the key. The second piece of the puzzle is there has got to be some level of technological uncertainty. So it doesn't mean that you don't think you're going to be successful in the project or what you're doing, but you may not necessarily know how you're going to get from A to B. And then that links to the third piece, which there then is a process of experimentation that you must go through in order to determine if that result was successful or not. Okay. The last piece of it is it's got to be for a permitted purpose. The way we explain this is you're looking for, are you trying to solve something that's measurable? Is it durability, quality, speed, performance? We're not looking at aesthetics like changing the color of a wing, right? You're looking at something, can it be measured? And did we improve or in some cases create something new, okay? Once you get past the 4-part test, there is 2 components that must be found within a contract, if you will, for it to be included as your R&D. Again, we went back earlier, we talked IR&D, that's pretty much a no-brainer, but then you have this whole concept of, we'll call it government, also commercial contracts. These contracts, there's 2 components that must be present in addition to the fact that does the activity pass the 4-part test. Those 2 components are financial risk and rights. And so we have financial risk here. And so are the payments contingent upon success? So are the payments contingent upon you hitting a milestone, submitting a report, delivering a prototype? Those are the things that we're looking for, not, hey, this is done on a reimbursement basis. You have hit a certain amount of hours and then you get paid for those hours. So are the payments contingent upon success is the key. Are you handing something over and then you are being paid as a result for that information? The last piece is rights. The best way for me to describe this is specifically through the SBIR STTR program. The way that those contracts are designed is that the government has rights into the research results, but you also, or the company also has rights into being able to reuse that in a different application or in a different function down the road, okay? So the way that the SBIR STTR program is designed, the rights piece is already taken care of because you don't have to have full rights into the research results. You only have to have substantial rights, right? So it doesn't have to be 100%. You just have to be able to have some, okay? So the reason why I brought that up is because for defense contractors, a lot of the conversations that we have with them will be something that goes like, hey, I at some point was told that government contracts don't qualify for the R&D credit because we were told that it was funded research. And whoever was providing that advice had said, yep, because somebody else, the government in this case, pays you to do this work. Because they pay you, that means it's funded. And so on the surface, that is 100% correct. There is an exclusion. There are multiple exclusions on the R&D credit. One of them is funded research. And so we included that in here. It says qualified research does not include any research to the extent funded by any grant, contract, or otherwise by another person or government entity. The problem is it doesn't say here what funded research is. So what we've done is we have included these Treasury regulations that just meet exactly what we just said on the previous slide, okay? So it says research does not constitute qualified research to the extent it is funded by any grant, contract, or otherwise by another person. Amounts payable under any agreement that are contingent on the success of the research and thus considered to be paid for the product or result of the research are not treated as funding, meaning they are not funded research. So when you're looking at the R&D credit, the way that I always describe this is funded research, bad, non-funded research, good, okay? The second piece of it, research in which taxpayer retains no rights. So if a taxpayer has no substantial rights in research under the agreement, the research is treated as fully funded. Again, fully funded, bad, non-funded, good. Lastly, research in which the taxpayer retains substantial rights. A taxpayer does not retain substantial rights in the research if the taxpayer must pay for the right to use, so royalty, so on and so forth, okay? What I wanted to do here next is simply just talk about some general contract types that we see and just provide, again, a frame of reference based off of what I just described about what the likelihood is that they would be able to qualify as your research for the R&D credit. Simply on the T&M and the FFP level of effort type contracts, these typically do not qualify because you are essentially, they are performance based. You are performing some level of effort. You are performing some amount of hours and you are being paid, not contingent upon the success, okay? So you are just performing those hours, being paid. Again, that would constitute funded research. On this medium level, this is where it can get a little bit more in the gray area. We normally find it mostly with CPFF contracts. 99% of the CPFF contracts we see fit that funded research piece, but there is a component on the back end where there is a deliverable that has to be submitted and approved in order for a company to be paid. So again, that's why we put this in the medium category. That's why you want to look at a lot of these contracts and determine how are they structured, because there are cases where certain contracts, you may have one piece of it that is qualified and one piece of it that is not. But then as you go over to the high end, FFP contracts, so those are generally milestone based. So a company is going to have a milestone in place. They have to hit that milestone in order for them to be paid. They have a report, a deliverable of some sort. That's the way those work. And those are very, very high likelihood of includability for a company. We mentioned earlier, IR&D, bid and proposal time. Bid and proposal time is an often missed piece of the puzzle. And it is not generally massive in terms of what the dollars create, but it actually can create a few $5,000–$10,000 when it's all said and done. Cost overruns is another one. You have a project, and again, you start having to foot the bill at the end of that project. That constitutes includability in terms of you being able to include that as part of your credit. What I wanted to do here is simply just, again, try to put all this together for people and just get an idea of what we're talking about and how this would apply in a real world situation. So what we've done here is we've listed out 5 different types of contracts, 5 different projects, if you will, each of them with a different dollar amount. And as you can see, we have different direct costs that are tied to every single one of them. What we really wanted to show, again, the firm fixed price contracts are oftentimes very good indicator that a company has qualified research. So we ended up saying in the first three examples, you have 2 Air Force contracts and a NASA contract. All of those direct costs, again, direct costs meaning the wages, the supplies or the materials, and the outside contractor costs tied to those projects, okay? Those would be includable at 100%, right? So we've moved those all the way over to the eligible expenses. That's why the direct cost meets the eligible expenses. That's why those are the same, okay? In the Navy contract, we end up showing that's a CPFF contract. And like I mentioned, a large portion of the CPFFs are not includable, but on average, again, that's about 1% of the contract value is what is includable. So that's why we have 3,500 that's includable on the right. And then we just have a commercial contract that's listed as a T&M as we discussed, because there's no financial risk there. That's why there would be 0 eligibility of that contract. No eligible expenses on the right. So in this example, you have $945,000 of direct costs. That ends up translating into 518,000 or just over 518,000 of what we would call QREs, qualified research expenses. And on average, what we find is about 6% of that comes back to a company in the form of the federal credit. And then there's on the state level, this is something we usually say, again, another 5 to 6. Every state is different. So there are some states that don't have a credit. There are some states that have a great credit. It really just depends on where the activities are being performed. But in this example, we just assumed, again, another 5%. That would give somebody a value, an R&D credit value of $57,000 out of $518,000 of qualifying expenses. So what that does is that these credits now are $57,000 in profit. And what that does is, I think I have an example on the bottom, is we found that most companies or most defense contractors are running at about a 15% net profit margin. So what that equates to is about, and again, $383,000 of new business development to create the same amount of benefit that the R&D credit can. So the one thing that we always say is this, is I don't know, again, in some cases it can be a lot of time, in some cases not so much, just depending on the business. But we always say for us, it takes about 6 to 8 weeks in order to get this benefit back in the hands of our clients. And so how much time does it take to create 383,000? That's kind of the example that we give just to show how valuable it can be. So that's it. I'm right at 30 minutes, just like we said. So I like it when I actually hit my time limits. So that's a positive thing. But at this point in time, we can open it up. Again, I know I made it very high level, but happy to answer any questions that there may be.
Hey,
Thanks,
John,
John. I'm going to just real quick, Chris, I'm just going to stop the recording. And so this part will be, we'll call this Chatham House or off the record, but for everyone in this call. So sorry, didn't mean to step on you, Chris. Please go ahead.
sorry, I should have waited. But John, question for you for the T&M contracts.
Yep.
Assuming that's best efforts and that data of those best efforts does end up going into the hands of the customer, does that change the R&D tax credit qualification or anything like that, because your customer could potentially use that data for research, or you're really sort of tied into a T&M, you might be in a box and you can't get out of it?
Yeah, you're in a T&M, you're most likely in a box because you have to have both of those criteria. So you got to have financial risk and rights. So it sounds like in that case, there might be shared rights, which is great. But if they're paying you on that hourly basis, or they're paying you on that T&M type contract, that's where that's likely not includable for you. Now, we've actually been in situations where we've had clients come to us and be like, hey, we have these as T&Ms. Like, are you able to restructure those contracts in a way that at least gets you some benefit? And that's what they've ended up doing, is they've restructured them in a way to make it a little bit more milestone based so that they could actually claim it. So it doesn't mean you're in a box per se, but you do have options if you have a relationship with your vendor, potentially, to be able to change that.
Okay, thanks.
Hey, John. Thanks for this quick question. So, what documentation do you recommend companies keep in order to have what you need to work with the CPA firms to kind of figure this out? Is it just the contract themselves, or between like what we would provide to the accounting firm and the contract, is that enough?
Yeah, that's a great question. I, I would say the more the better. And I know you're saying what specifically. The contracts are a great start. From our perspective, I can only speak to our perspective on what we do. We gather documentation a few different ways depending on what the client has. So if there are emails and things of that nature that we can gather, that can serve again as good documentation depending on the situation. We've also gotten to a point too where there are things that you can do from an interview perspective. We always conduct interviews because we like to get a nature of, hey, this is the full scope of the projects. We can take things that we hear from those interviews and be able to ask, okay, what if you have this? What if you have this? Because if they don't have that documentation, I think what you may be kind of referencing here too is if we don't feel comfortable defending it because there isn't documentation, it may be something that we leave out in a current study, but something that we recommend that we institute so that we can capture it for a future study. But there are ways around documentation in terms of, like I said, it may not be a hard, fast drawing of something or something of that nature, but if you have emails and things, we can go back through and use those to help provide qualification and quantification.
Okay, and does the type of funding ever come into play? Like, let's say it's not just like SBIR sitter, but kind of like any R&D funding. Does that pretty much like automatically kind of qualify as long as you can determine those eligible expenses, or like in a government context, does that not really matter? It's more like it could be O&M money or it could be procurement money. It's more like the performance of the work that you're auditing to see if it's R&D. Because ostensibly, the government doesn't want to fund R&D via other types of money, but they kind of do, right? Like NRE is a perfect example that's sometimes funded with not R&D money.
Yeah, I always hesitate to use the word automatic, but I will say this. We talk about government contracts just because they kind of lump themselves into their own category. In reality, any type of contract, government or commercial, you are looking for those three criteria, right? Does it pass the 4-part test? Are you at financial risk? And do you have rights to the IP? So that's what we end up doing is rather than sitting here and saying, we can sit here and say, hey, there's a high likelihood based off this contract structure. From our perspective, we end up taking a look at every single contract to determine whether it does qualify or not, because we know which clauses to look for, which indicate includability, yes or no. So I don't know if that directly answers your question, but if it doesn't, let me know and I'm happy to try to rephrase that.
No, that does. I mean, so that 3-part test is pretty much the template you follow for anything. And
yes,
however much robustness can be provided in each of those 3 things will inform the audit, essentially.
That's correct. In reality, okay, you can really, with IR&D, because you're footing the bill and because you have rights, you really don't need to worry about that. You just need to worry about, for IR&D, does it pass the 4-part test? Because you already, but again, yes, in essence, those 3 criteria are what you're going to use every single time.
Thanks.
Sure.
Hey, John, another question for you. This is Chris.
Yeah.
In prior lives at some companies that were a little more advanced, we'd have an outside firm come in, they would do their interviews, they would assign X% of this person's time, that person's time in the production process. And that's what would flow into ultimately the amount of R&D credits that we would take and reclaim.
Mm-hmm.
That company that I was at, and those didn't necessarily have like the DLA activities, the SBIR activities. to the extent you end up having an R&D study and there's certain percentages done, how does that kind of complement or contradict what your firm would be looking at as it relates to these government contracts and some of these specific eligibility items?
Yeah, I think first and foremost, we always ask if there's time tracking, because not everybody has that, right? Time tracking is the easiest thing that you can do to actually specify how much time did this person spend in qualified R&D or not. To your point of qualifying percentages, and I don't know if this was the case, again, what we normally see when we see other outside firms do that approach is they look at a small sample size of projects. They say, oh, this person spent 70% of their time there, and they apply it across the board. We take a look at every specific project. And again, there's other methods that you can use in order to quantify time without time tracking. So those usually it just goes through questionnaires and things of that nature. But what we found is by applying a consistent percentage across the board, you really are, again, you're getting a number, you're getting low-hanging fruit, but you may not be quantifying the maximum amount that you could be. And the reason why that's really important is because when you actually get to an 80% threshold of time per individual, right? So let's just say 80% of their time is constituted as spending under qualified research, you can actually include 100% of their wage. So that's why we don't apply standard percentages across. We end up trying to figure out, okay, what was their actual amount of time spent across all these R&D projects? Because on a small sample size, it might be 70, but when you look at time spent across the board, it could be 80, which means that ends up bumping their credit up. I don't know if that makes sense and is exactly what you're asking, but that's our approach, which is a little bit different than what you may have experienced in the past.
Sure. Yeah, it does. I appreciate that. It does make sense. Thanks.
Yep.
These are some good questions. What else we got?
Yeah, if there's nothing else, that's perfectly fine. I think more than anything, the goal of this was, at least from our perspective, we really enjoy sharing this information and getting this information out. Hopefully it's something that, again, you may have heard something different coming into this conversation, specifically tied to the government contract side of things, and what funded research is, and is it includable and is it not. I think the short answer is it can be, depending on the type of contract that you have. But simply saying, oh, nope, it does or it doesn't really dig deep into the issue of, is it funded research or is it non-funded research? So those are some things I really want to make sure that we emphasize to help you guys get a gauge of, oh, I may have something here, or I definitely don't.
I do have one follow-up question.
Yeah.
John, could you comment on the priority of R&D tax credits utilized versus NOLs and expiration, and what you do first and the benefit in terms of how that applies to cash? I know you cited the applicability against payroll taxes that kind of offsets that immediate cash with NOL, but interested in that interplay.
I know NOLs will come first, and then general business credits, which is what this is, will come second.
Great.
Yep. Hey, I didn't
when
know
do they expire?
That was very good. That was good. That was specific. No, does it expire?
Or when do R&Ds expire?
Yeah, so they do expire, but on the federal side, and I think this is a really good segue and something I wanted to mention. I had it in my notes. They carry forward the federal credit carries forward up to 20 years. Okay. It can also carry back 1 year. So getting a little bit more into the specifics of it, I know we mentioned the R&D credit in terms of looking at the expenses and how you can try to gauge your credit. I also mentioned that's a general rule of thumb we use to help people get a gauge of how much opportunity there could be. In the complexity of the credit, you are actually, in order to compute it, you are taking what is happening in a given year and you're comparing it against the 3 previous years. Okay. So if nobody has claimed a credit before, let's say they've never done it before and they wanted to claim one in 2023, well, we would still have to go in and compute 2020, 2021, and 2022 in order to get an actual calculation for 2023. I know that doesn't answer your question, but the reason why I get into all of this is because you could sit here all day and talk about, hey, yep, my credit is $60,000. The more important thing is, what is the usability of the credit, right? How much tax do I have to offset? So even if I had $60,000 in credit, but I only have $20,000 in tax, well, that matters in terms of planning and so on and so forth. So I know you asked the question. It can carry forward 20 years on the federal side. It can carry back 1 year on the federal side. On the state side, like I said, there's states that don't have it. There's states that do. We have seen in terms of carry forwards, it can be 10 years on the state side. It can be 18. It just depends on the state.
Great, thank you.
Anything else from anybody else on the call? All right, John, this was awesome. Obviously a ton of information. You shared your contact with us, but I will go ahead and send out to everybody who joined today how to get in touch with John, and I'll send you a real quick 2-question survey. We'd love to know if this was useful or how we can make it better. We'll keep that anonymous, but appreciate anything that y'all can share with us. So thank you, everybody, for joining us this afternoon. If there are other topics that like this that you think would be useful, let us know. And if you want more of these types of webinars, we got John and I have a bunch of other topics that we were thinking of taking through as we, both in terms of webinars and in terms of a more fully fledged course to dive into some of this deeper. So if any of that's useful, reach out to us. We'll share some information, but appreciate everyone taking the time. And John, thank you for your generosity, time, and insight.
Absolutely. Thank you, everyone. Again, this has been great. I appreciate everyone showing up. And again, if we can be of help in any way and answer some questions, happy to do so.
All right, everyone. Thank you.